Hi fellow investors. In her recent interview with Bloomberg, Savita Subramanian stated that the duration of US stocks was about 30 years. I immediately noted that point because I attempted to calculate the duration previously and my estimates were closer to 20. And in this video we are going to go over the math to get the stock duration. First, let's start with the present value formula, which is the sum of all future cash flows, which can be represented as an integral. Solving the integral from 0 to infinity gives us a general formula. It is very similar to Gordon growth equation, which is a rough approximation. We then do the same with the duration calculation. We make an integral and solve it, and the result is very similar to what we had in our present value equation. If we substitute present value here, we can simplify the duration calculation to approximately 1 over r minus g, but with logarithms. We can stop there, but I want to make it even more intuitive. If we assume that the cash flows in our calculations are earnings per share, then present value equation looks like this, and duration is basically the forward price to earnings ratio. We can also choose to go with free cash flow, and then duration is equal to 1 over free cash flow yield. Either way, our calculations give us durations for the stocks at about 18 to 19 years, which is far from 30 or more. To be honest, it is very hard to get to 30 years duration. If you assume higher cash flows, which have to be almost 50% higher, the market is extremely undervalued according to our present value calculation. If we assume lower present value, or that S&P has to be 30% lower than the current levels, then it effectively lowers PE ratio and decreases duration. Basically, changing cash flows and present value contradicts the formulas themselves, so we shouldn't touch them. We can also increase duration if we assume that the discount rate is almost a percentage point lower. This would, however, mean that S&P has to be over 5,000. Increasing the growth rate is basically the same. So now we can calculate what proportion of recent 23% decline in the S&P can be attributed to the higher rates. 20-year bond yield rose by 145 basis points, which would imply about a 29% move in the price. However, stocks' perpetual cash flows result in high convexity, so the actual effect is smaller. We can generally conclude that the decline is mostly attributable to the rise in yields. The 30-year duration, however, would have implied a 37% move, and even convexity would have a hard time explaining the difference.